Your mind is an amazing machine, doing far more than you can imagine. It's your biggest ally, but it can be your biggest enemy, especially when it comes to your finances. I'm Dr. Daniel Crosby, and we're going inside your mind to put you on your best behavior. It must be stated plainly that buying one single stock is a risky proposition. According to JP Morgan, 40% of stocks have suffered catastrophic losses since 1980, meaning that they fell by 70% or more. But what happens when we pool those risky individual names into a diversified portfolio? Jeremy Siegel found that in every rolling 30-year period from the late 1800s to 1992, stocks outperformed both bonds and cash. In rolling 10-year periods, stocks beat cash over 80% of the time, and there was never a rolling 20-year period in which stocks lost money. Bonds and cash, considered safe by volatility-based measures of risk, actually failed to keep up with inflation most of that time. As Siegel says of this twisted logic, quote, "You have never lost money in stocks over any 20-year period, but you have wiped out half of your portfolio in bonds after inflation. So which is the riskier asset?" Over the past 30-year rolling periods, stocks have returned 7.4% after inflation on average, whereas bonds have barely kept up, clocking a real return of just 1.4%. I'm not sure what you would call an asset class that outperforms by an average of 500% a year and does so with great consistency, but I wouldn't call it risky. Another danger to the volatility-based notion of risk is that it keeps us mired in the day-to-day gyrations of the market instead of focused on the long term. Once again, stocks do seem very scary if you're looking at them every day. If you check your account daily, you'll experience a loss just over 41% of the time. Pretty scary when we consider that human nature makes losses feel about twice as bad as gains feel good. Look once every 5 years and you would have only experienced a loss about 12% of the time. And those peaking every 12 years would never have seen a loss. 12 years may seem like a long time, but it's worth remembering that the investment lifetime for most individuals is more like 40 to 60 years. Long-term investing demands equally long-term measures of risk. Considered against an appropriate timeline, a portfolio with equities as its primary driver provides a great deal of reward with very little risk in the most meaningful sense of the word.